Well, I'm going to the city and I'm gonna do a silly show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone reclining, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askslim.
Hi, I'm Steve Miller. Call me Slim. And this is the askslim Market Week. It's a look back at what happened in the markets in the last week and a look forward at what might happen in the next week. And this was a week that saw, well, a lot of firmness in markets. U.S. stock market fell back midweek, but then got some real legs going on Thursday with a really big up day. Bond market also relatively firm. It's not often that the two markets are firm together, and the gold market, we'll call that strong this week, as it got a good gain on weakness in the U.S. dollar. Some pretty dramatic moves during the week on earnings and some buyouts, so we'll take a look at those in just a moment. And overall, equity markets in the world were firmer this week. China, one of the better markets, and we saw here in the U.S. some strong Chinese ADRs, especially on Friday when we had some buyout news in that particular sector. So today, later on in the show, we're going to look at, well, of course, the best and the worst for the week, and then I will answer some of your emails, some really good ones there, and then we'll look at my short-term view for the coming week. We'll start out by looking at a 60-minute chart that gives us a sense for the moves in the stock market during the week on an hour-to-hour basis as we look overnight and during the regular trading session, and whatever the background influences might have been in the market. So we're going to switch over right now to that 60-minute chart, and here we go. This is that unusual chart with all of this news and information right on there. So we'll take a look here at Monday, and Monday the markets were kind of moving sideways. There was not a lot going on in the markets at that time, and we'll just call it some modest back and forth chop. The Eurozone was mixed to lower opening, but Japan was a little bit stronger. China up 3% on more chatter about stimulus. Airlines had a good day on some analysts' bullish comments on airline earnings. During the week, of course, we saw a swoon on the downside in oil, and that always helps the airlines. News came out that Dell was buying EMC. They were going to have a tracking stock on VMware based on EMC's holdings. That has put pressure on VMware all week long. Eli Lilly ends development of a cholesterol drug, and Regeneron gets a 4% pop on that news as Lilly moves down 8%. And Regeneron has an alternative drug. So oil moves lower, oil stocks ease back, and overall, we'll call it a very, very dull day on Monday. Tuesday comes, and you could see that overnight, well, the market did get a swoon as it moved to the downside. Eurozone was down between 1 and 1.7%, and France the weakest. Economic news still was coming out weaker. UK inflation down 1%, so that's deflation, right? China imports down 20%. I mean, that is really the stuff that brought this decline that you see there. U.S. stocks, well, they finally fall to the downside as they try to rally as the market opened. You can see that, but then started to really give ground, and a correction was due, and that one started to come. So Twitter up about 3%. And they cut 8% of their workforce and guided lower, but, well, I guess they think that that's good news. JetBlue down 7% on a downgrade by J.P. Morgan, and that leads the airlines down, and Dow Jones Transport a bad day, and that's what really was weighing on the markets, was the transportation index as we get a real pullback. So we had expected a midweek pullback, which we got right in here, you could see, but I got to tell you that this didn't get down anywhere in this as far, much as long as I expected, as I thought it would continue down through the most of the week. We'll look at that in my short-term view. On Wednesday, the markets moved pretty much sideways overnight, got a little boost in the morning. World markets were lower, Japan down 1.9%. Retail sales came out soft, but Walmart cracks 9% on a weak forecast. And you could see right in here that big downside bar as the Dow Jones got greatly affected because Walmart's in the Dow, and that pushed the stock market to the downside for the day. Walmart blames employment costs and so much for the benefits of minimum wage. That pushed the Dow down, and that didn't really get saved by any of the other good news out there, like Trip, which was up 20% as they do a partner deal with Priceline, and Expedia, based on the competition, it falls 4%. SanDisk, SNDK, up 12% as they actually explore selling the company. And bank earnings start to come out, and they start to trade weekly as the bank earnings were on the mixed side. Thursday comes, and overnight you see the rebound in here beginning, and the Eurozone up 1%, China up 2%, so they were starting to get some buying coming in. U.S. CPI, weaker than expected, down 0.2%, the core up 0.2, and inflation is on the soft side. Jobless claims, this is really unbelievable. Super strong. Only 255, that's the lowest since 1973 on an average. Philly Fed, though, comes out, and it's really a weak number, 2 months in a row. So you've got really conflicting data coming out here. Weak CPI, weak Philly Fed, but then strong jobless. Xilinx up 5% on an earnings beat. Seagate, holy cow, 13% as they guide lower. That pattern was looking okay, and Western Digital, which trades a lot like Seagate, also got hit, and Western Digital had led them up a couple weeks ago. Netflix down 8% as their sub-growth misses, and that's a big disappointment. So right in here you see that disappointment right there that lasts like less than an hour, and then the market got legs. All of a sudden, buying came in, and S&Ps close up. The futures over $30, is $35. So it was a monstrous update for the stock market on Thursday. Friday comes, and, markets start to just kind of chop sideways. It is another very, very dull day in here. Tries to get a rally, but we're getting up to the top of a resistance area. Again, I'll show you that in a short-term view. And then the market starts to pull back, but only by a little bit, as the S&P future is only down midday here about $1. So no big deal here. Rally fails, but not much going on. World markets are slightly higher. The big news is Yoku jumps big time as Alibaba bids $26.60 for the stock. That is an amazing move. We were bullish on Yoku. I'll show you that chart in a couple minutes. Lulu up 4% on a Credit Suisse upgrade. And overall, that chart has got a short-term inverted head and shoulders, but long-term, I don't really like that pattern. So you could take a look at that, and you'll see the short-term inverted head and shoulders. Spirit Airlines, SAV, down 13%. Morgan Stanley downgrades the stock. Clearly the worst airline chart of all of them out there. Like United Airlines, but that one is bad. And Seagate again slides 4% as analysts pile on the downside. So that is a look at what went on last week, what the market influences were, and you could see that midweek swoon did not get very far to the downside, and buyers came in pretty aggressively. So what are we looking at for the next week? Well, we're going to take a look next at our economic and earnings calendar, and you will see that, the earnings deluge is beginning right now, and we're going to see tons of this now for the next few weeks. You can just make a screen print of this calendar, and then you'll have it in front of you. There's a lot of the earnings reports in here that are not we just haven't been able to verify the exact times on them. So you'll notice some of them in here have a star on them, like you see that United Airlines or Royal Caribbean Cruise Line. So we have not verified the time. You might want to verify those. But that's how they show up on the calendar. So you can see I'm not going to name them all, the earnings are just going to be pouring out in here. Lots of big ones coming out during the week. Monday after the close is IBM. That's a big one. And then, of course, American Express after the close on Wednesday. We have on Microsoft comes out on Thursday after the close, and Google. By the way, I reported Google wrong to you a week ago as we had it in there on the wrong date, but this is the right date, and we have verified that. So not much in the way of economic events coming out at all. There's not one in here that I think is a market mover on this earnings and economic calendar. So that's basically what we're looking at coming up in the next week. It should be an interesting week, and there should be a lot more movers on these earnings reports. So that's it. That is the first segment of the show. We're going to take a break now. When we get back, we'll look at the best of the week. For the best of the week, it was really all about deals this week. We're going to take a look at 3 deals that move stocks up pretty good. One of them is the one I have traded a lot recently, and it's just going to go away as Alibaba is buying Youku. I had no position in there, and man, I have been long that one a lot as I thought it was making a bottom. Take a look at this chart pattern, and you'll get a good idea here about cycle patterns and how they work just by looking at this. It's almost perfect where you see, notice these cycle brackets on the bottom. That is how you tell the rising and falling periods of a particular security that you're looking at. You can see these beautiful time cyclicality, the rising zone that we were in right here, and this big up week that we see. Youku up 23% on the week on that news that they're being taken over by Alibaba at $26.60. Youku, a Chinese media, internet, and TV company, and obviously Alibaba wants in the business, and great, probably, I'm going to say great acquisition by them. Notice here on the daily chart the saucer bottom that formed and the breakout. Well, who would even know, right, that it was going to just fly over this 89-day moving average, which was a good resistance for it in the past, and there comes that news. So Youku gets the big buyout, and that stock is going. And good for you, Alibaba. I think it was a great acquisition. Trip, that news comes out. That's TripAdvisor. That is the online travel service. They make a deal with Priceline about their instant booking, and that the investors love that deal. And actually, you know, people that were holding on to competitive stock like Expedia, well, they sold that one. So let's take a look here at Trip, TRIP. That stock up 18% on the week. We'll take a look at the weekly chart first. Now, weekly charts are what I look at the beginning also, because I do all my cycle analysis on the weekly charts, and that, of course, is my unique style of analysis. And this is another one where this news comes out almost perfectly timed as we get into this positive time frame. Here is this TripAdvisor chart, and what we're looking at in here, by the way, is a stock that was on my list for the riskiest of 2015, and it had a couple of good rallies and was actually down on the year, and then this news comes out, so you just never know, right? Here's the cycle patterns, and here you could see the rallies and sell-offs is a little bit smaller cycle in duration as the one I just showed you in Youku. Here's the low do right over here. Look at that, 3 weeks up, and the stock makes this deal, flies on the upside, and has this giant move of 18% on the week. Let's take a look at Maxim, MXIM, up 11% on the week, as news comes out that they are in discussions with ADI, and sorry about that, I don't know where that chart went, and I'm having trouble here. Let's try one more time, and there we go. Sorry about that delay. So let's put this where we can see it. And here is the Maxim chart, and this one not as clear on the cycle patterns as we can see, as the lengths between lows are on the erratic side. This low over here, not bad, but then this giant up move as this stock moves up 11% on the week on their discussions with Analog Devices, ADI. So those were three of the biggest movers for the week. Gold, of course, had a big upside week, and that lifted the gold stocks, silver stocks. Gold Corp up about 10% for the week. Barrick Gold, ABX, Gold Corp is GG, ABX is Barrick, and that was up about 7% for the week. So good movers there. Nike also had a very strong week as Piper Jaffray, Morgan Stanley upgraded their target in there. Last week I put out Nike as a stock I was looking for on the downside. There was a pattern in there that is normally bearish called three black crows. That pattern failed, and these upgrades and strong markets moved the stock up. So every single candle pattern does not work, and in this case that one did not. We also had some other stocks that were really super strong this week, just all across the board, lots of them up in the 3 to 5% category. The stocks that I'm looking at this week for potential upside moves, and I want to talk about the stock market later. I actually think that the stock market will probably have a quieter week, and I'll show you why I think there's a range there for the market. And the ones I think that are going to get some upside moves are stocks that were weak towards the end of this week. I think that value investors are going to be coming in and looking at some of the beaten up industrial stocks. So I'm looking for upside moves in U.S. Steel, that's X, and the industrial group, the four stocks in the group that I think can get some upside play. And we're talking about a swing trade to the upside for about a week or a little more, is Deere, DE, CAT, CAT, Joy, JOY, and Cummins, CMI. That's what I'm looking for the coming week. And that is the best of the week. For the worst of the week, it was almost all about earnings or downward guidance, poor outlooks, the things that move stocks down in a big way because investors can't wait to get out when they hear that stuff. And we're going to look at a few of those right here. The first one we're going to look at is Seagate, STX, as this stock takes just a big hit. It had a nice move up with Western Digital just a week ago. You could see that right over here. But then they come out and they say that their earnings are going to be bad, so that lowered guidance knocks the stock down 18% on the week. Just an incredibly bad pattern that we're looking at in here. And you can actually see what it looks like when you get a stair-step upward pattern in the cyclical patterns. You see that one right in here. And then when all of a sudden it comes down and equals the pattern, how do you like that? And then it comes up and then it fails underneath this level and gives you this negative pattern. Yep, look what happened in here. There's your head and shoulders top. So anybody that says, well, head and shoulders tops, they're just like coincident, they don't mean anything, that's all formed by cycle patterns. And you can see right in there how these cycles formed this head and shoulders top, the failure right at the resistance number right there at the 34-week moving average, the downside dump on the right shoulder and extending all the way down through the cycle timing period over here, and then just playing out another failure. So bad looking stock there in Seagate. Amazingly, right in here we caught a little bit of a bottom, made a little long side trade, but I was out of it by that time, and thank heavens for that, because this pattern now says the stock's in trouble all the way out until February. By the way, our outlook for the stock market has it not being in good shape out to a similar date. Not that Seagate has a lot to do with that. Another one on the downside that was really bad is Netflix. You don't expect this one is going to disappoint in any big way, but their subscribers did disappoint, and that's the sub growth. Though they did grow, we were looking for another pullback in here in Netflix. to the support zone. You can see this big cycle right in here. How do you like that big thing right there? And then the next big one got you this big rally, and then in this sell-off period right here. So we believed that this was a bear flag that was forming in here, and it was going to come down again, maybe down to support. This is a bad pattern. It looks like, well, 92 would be a decent target for this stock. That would be about 7 more points on the downside. Could get down to 86 based on this support zone coming in right over there. So not a good pattern. It has maybe another couple weeks in this downside in here, and we're going to look for some more pressure to come in Netflix. That is a bad pattern. Also, talk about bad patterns, you've got to look at Walmart, which broke the market on Wednesday, but it couldn't stay down. Here's the Walmart pattern. Look at all of these cycles, how rhythmic they are, and you will see in here this stair-step downward cycle that had almost no rally in here, came down to this level, almost no rally, and likely to move down out here into January. That's the timing in here. So this big downside break here, it's all about, well, the costs are going up. That's employment costs. 2.7 billion over the next couple of years because of the upward pressure on minimum wages, and that's going to affect them. And you got to believe that, you know, stocks out there, other ones are going to get affected too. My number one is McDonald's. McDonald's trying to do an REIT right now, and that it sounds like trying to get a boost in value in McDonald's based on that. You know, I can remember when Sears did the same thing, SHLD, and usually when they're doing something like that, trying to, you know, boost value by using the real estate, it simply says that they're having problems boosting value other ways. So I think McDonald's could be in some trouble, and they have earnings coming out soon, so I guess we'll see. I am short some McDonald's right now. Got to let you know that. The other stocks that had big moves to the downside, Navistar down 16% on the week, just seems to be in free fall. It's got a really negative pattern. That knocked Joy down about 11% also. Now, remember, I mentioned those stocks in that group for the best of the week. I think there's a bounce coming in there, and I'm playing a bounce. But again, it's just a swing trade, and when I trade counter trend trades, they are small. I don't make big trades in those stocks. Also, on the downside was that VMware on that deal where with EMC, where they're getting taken out by Dell, and that's going to leave that tracking stock there in a VMware. So big downside move there. Save, SAVE, Spirit Air down 11% on the week. GMCR down 11% on the week. Both of those have got some really ugly looking patterns on them also. So what about this coming week? What stocks do I think have some downside in there? Well, I think the stock market might, you know, be able to hold up in this next week, but I think there's a few stocks that have some downside move coming. Now, I mentioned McDonald's, and that one, it's all about this REIT. I don't know what kind of response there'll be if they actually come out with some way to spin off their real estate. The initial response on something like that is usually bullish. So were that to happen, I'd probably sell into strength on that, even though I'm just a little bit short in McDonald's right now. The other stocks that I think have got some downside in them based on the patterns, Las Vegas Sands, LVS. Wynn came out with some comments today about how bad it is in Macau, and both of them got hit and then bounced back, but LVS is up to a resistance area, and I think that one has some shot at pulling back again. Boeing also, BA, that one is in an area where I think it can move to the downside, and Costco, COST. So those are kind of my four stocks that I'm looking at for downside swing trades this coming week. And that is the worst of the week. Emails and tweets. Had a great mix of emails this week about trader issues, strategies, for analysis on particular symbols. Really good stuff. I'm going to start out with WA, who asked me a couple questions. Starts out with, what are your thoughts about straddles and when do you use them? A straddle, of course, is when you're buying or selling both the put and the call at the same strike in a particular underlying. So selling a straddle would be selling the put and selling the call. Buying the straddle, buying the put, and buying the call. I seldom use straddles. That's just my own preference. I know lots of people out there like to trade them. I would much rather trade strangles, which are much further out of the money. And the way that I do trade strangles when I do is only under certain conditions of implied volatility. So if implied volatility was very high on something I was looking at that had popped quickly for some news item or something like that, then I might sell a straddle, but it would be for a very short holding period, just for essentially a scalp. And I would buy a straddle, but I'd buy it under a much different circumstance. That would be when I have some technical reason to believe that's going to be a big move in one direction or the other. Implied volatilities then would probably be very low. And a good tool to use is the TTM squeeze, because the TTM squeeze is telling you when that fires, it would then tell you that it's likely that there was a good sized move coming in one direction or the other. So that's how I would use straddles. Also, WA asks me, he says, it makes a point. First, your video that you did, which was setups for scalpers, he says that's a great piece. If you're not a member, you might want to become one, because that is really an unusual way to look at chart setups for people that are very short-term traders, scalpers, day traders. I think it's great. Even for swing traders, you can use it. So great piece. Thanks for that. He says, I tend to follow this concept in all of my trading. And it's a good thing from my perspective, as your piece gives me much greater confidence in my approach. A great point, WA. The difference in what I presented was the focus on momentum and identifying momentum, and then using that to maximize gains on your winning trades and minimize on your losing trades. And that's, of course, the key to profitability is in all styles, all holding periods, when you can do better on your winning trades and then on your losing trades, and get the winning trades more often. That's the formula for big success. A little bit of an exception to that would be for strategic option traders, who tend to have smaller winners than they do losers, and I often question that style. KV writes me, and he says, I'm an intermediate trader trying to find an edge in the market. Always trying to learn what will happen next week by looking at things over the weekend. He says, I see some people read Barron's and some get some proprietary articles from sources, he says, which I don't even know where they come from. Any suggestions for traders like me? And well, first of all, I got to tell you, I've been around for 41 and a half years as a trader, and I haven't found any way to get any really great information from anywhere. It's all my own work, my own study. I still read Barron's every single week. I read it a lot less thoroughly than I used to. It's really become not such a valuable resource for me. I used to love it when Alan Abelson was there, but sadly he's been dead for a while. And he was a great writer and really enjoyed his commentary. And I really think that Barron's has gone the way of retail institutions, and it's just stuff that's not interesting to me most of the time. I also use a lot of other resources, though. There's lots of them out there. I scan Twitter more than you would believe for news items, and Yahoo Finance and FinViz and Google Finance and Seeking Alpha. I mean, those are basically my main sources, and I spend a frightening amount of time in front of those sources scanning constantly for important news items. So that's what I look at. Also, KV asked me about a couple of stocks, wants to know my view on United Airlines and Lennar. Let's take a look at those charts on United Airlines and Lennar. UAL, of course, the airline stock, and that one is taking on, I would say, a nice pattern in here. We have oil having turned softer, and that, of course, is always beneficial for the airlines, whose main input costs are fuel. So let's take a look here at this UAL chart. actually have two charts up here, and that on the left one is the weekly and the right one is the daily. Let's blow up the weekly here, and you could see that we're actually, based on the cycle patterns that we look at, we're looking for a low to come right in this time frame right over here. So that's, now or in a week ago that low, or in a couple of weeks maybe one more dip. And then we're going to get into a period of rising cycle in here, and we're going to look for coinciding with a belief that we have that oil may have some difficulty in the near term. That's probably good for United Airlines. So you can see that's a nice positive pattern in there when we look at the weekly chart. Take a look quickly at the daily, and here we will see that it's gotten a nice move on the upside, as we saw on the weekly. Now, what I do like is this gap right in here. This is a really nice pattern when you get that, and it's actually a double gap. There's a small one there, and now it's just consolidating sideways right now. So I think any little pullback support here right around the slim ribbon, 13 and 89-day moving averages converging right there and crossing over. I would say positive momentum showing up. You get it around 55 to 56. That looks like a nice entry in there. So I think it's a good looking pattern. Also, you asked me about Lenar, L-E-N. So let's switch back over to the weekly chart, because I always do start on the weekly when I do my analysis. And we'll put up Lenar. You're going to see some similarity in the pattern in here, as this one also is looking like it's made a low. The blue cycle on the bottom is the XHB, so that's the Home Builder Index ETF. And here we have these upturns right in this area here, and now you could see the upturn in here. So this is good. I mean, I think that we'll call this pretty good and likely to move up further in this rising period. One thing I don't love is that this decline right in here gave up about 3/4 of this move in here. Now, what often happens is when you get that kind of a move on the downside, then you notice in here, this one gave up only about 1/3 of this advance. This one gave up about 1/2, maybe a little bit more of this advance. This one gave up 3/4. What happens is that maybe you get up into the resistance, and then you start to roll over again. So we're going to call this okay, looking like on the short term it can move up a bit, but then after that maybe it'll start to falter in those mid 55s once again. So good questions. Thanks a lot for that. Next is from RJ, who writes to me, and he says, thanks for providing a lot of great information. I've been trading with what you call FOMO, F-O-M-O. That's fear of missing out. I would appreciate your thoughts on how I may trade better and get better timing. He says, of late I've been trading short, and the market has, we've expected a correction on the downside. However, it's taken time to make the turn. And he says, I entered early on this trade and also on a recent oil trade. So what is the way to improve upon this? This is, a tough question. There's a few answers that I would give you in there. And I have to say that, what you're talking about, and that is entering on trades in a way that there's fear based in it, and that the timing then gets wrong. I've done that plenty in my career trading. And here's a few things to consider. First one is make your first entry small. I do that all the time, and then I can evaluate, see if the technical reason that I'm in the trade is still valid. Once the market moves in the direction that's expected, then I will be able to accelerate into the position and have a much bigger position when it really feels right to me. I don't add to losers very much. I mean, I might, because I enter into a position small, then there's room for me to add to a loser, and I will add to a loser in some small way if I still believe the analysis is the same. So I don't have a real hard time about that. Here's my suggestion. That is that your trades are broken into like 3 or 4 units, and your entry is like 1/4 or 1/3 of your maximum position. And then if it goes wrong and you don't have confidence in the analysis, you don't get that emotionally, you don't get the emotional hit, essentially, because your position is so small. And then you can, come from an intellectual place and reevaluate it and, maybe add to the position, maybe not, or maybe just get out because, well, it's a small trade. You didn't get into the whole position and, it's just not right. So you get out. Or maybe it's still right and you just hold on. But with the smaller entry, it will help you a lot in that. Next one is, making the trade your own. It's if you are, listening to me or listening to somebody else out there that's giving market opinions or opinions on securities or futures, and then you get into the trade because somebody else said it, then you don't really know what to do because it's not your trade. You're going to wait and see and hope that it goes your way, or you're going to wait to see what somebody else says. So it's really important that you make it your own trade within your own risk parameters, and have your own areas where you're going to exit when it doesn't feel right, and you have your own analysis on it, so that it's not somebody else's analysis, it's yours. If it's your analysis, then you'll know when your analysis isn't going the way you expect it to. So that's number 2, and I think that's really important. The next one is that there may be some emotion at play here. And that would mean that, there's part of you internally that you're not really sure about what it is, that is driving your exits and entries too quickly. For some people, they have to be right because the cost of being wrong, the consequences are too big. Or it might be that they have to make money. They have, left a job, or they've made a commitment to somebody that they're not going to lose any more money. And all of a sudden they have losses, and they want to get it back quickly. So they will, get into trades, chase trades when it's not good timing, or they'll have losing trades and then not exit them appropriately because, well, they don't want to take the loss. They're hoping for it to come back. It's that I have to be right. I have to make money. I have to do something. I've given some role to trading that I want it to fix something for me, and that's never going to work because then it's all the trades are emotionally based. So you have to really think about if any of that fits for you out there that are listening to this. Do you have too many things going on that you're asking trading to fix? And that's when emotions will come in and play with you, and the timing will be really tough to get in your trading. So that's kind of a rhetorical question. You don't have to write me back and tell me, but if you want to, you can. KC writes me and he says, what are your thoughts on Nordstrom, JWN? He says it's in a rising phase. Now he's been doing analysis, a cycle analysis in there, and talked about the 13-week moving average as a reasonable target on JWN on the upside. So let's look at that. I actually think that there's a resistance in JWN a little bit lower, KC, than you're talking about. But let's put this up so everybody knows what your analysis is. And we'll put up Nordstrom on the weekly. And here it comes. There it is. So here is Nordstrom, and here's the cycle analysis. You could see the cycle in there. It's very, very clear because on our charts for our subscribers, we keep all of the cycle analysis. So look at this, a low do here, and this like little hammer look right in there. And what you said is that you thought the 13-week moving average, which is this black line right here, might be the resistance line. So this rising phase is what you're seeing, the likelihood of getting a rise up here, and that would be up to about 73 or 74 based on that moving average. So that's not bad analysis in my mind. As a matter of fact, if you look at Fibonacci retracements, and we're going to do that from the peak of that cycle to this part of the cycle here, that's the 50% is at around 73, the 618 is around 74.80. So that's kind of the resistance zone, and that's exactly where this moving average is on the weekly, the 13. So I think you're doing good analysis, and I would say that it's reasonable to think that that could happen. So that's that rising phase that we're looking at, and you putting the target on that 13-week, which is at around the 50, and moving up that way. I don't have really problem with that. The one thing I want to point out, though, is that here you can see that there's a big downside gap in here. And when you get a big downside gap like that, That is an issue. It's really hard to overcome that. The volume really wasn't all that big. It's not like you had any exhaustion going on there. Now you can look in here, and this is a hammer bottom and a harami. Harami is Japanese for a body in a body, which is a baby. So there's your harami right there, the body inside of the body, and the hammer. And that does say it's making a bottom right where we saw that weekly cycle low do. So that's a good sign, right? Now here's the slim ribbon and the 13-day moving average coming down right here. Here's the 89-day, which has proven to be very, very powerful resistance right here. And that's in that area of the 618 on the weekly, which is around 74.5. So that's the upside target. I actually think that this area right over here is going to be difficult for it first. We'll call that 69.5 to 70 on the upside. That's the area if I were long right now looking for an upside turn, and if I were long it would be with like a third or a quarter position because downside momentum in here, no confirmation of a bottom. I would just be barely anticipating, and that would be a small trade. And then right in here, 69.5 to 70 would be my upside first target, and I'd be taking profits right in that area right there because, well, that looks like a tough spot for it. But you did great analysis on it. I like that, and lots of people out there, working hard to learn the cyclical analysis, and you did a good job on that one. Thanks. Next question is from Anonymous. I'm going to keep this one anonymous because this is a kind of a tough question. I don't want to expose this person at all, but it's so valuable that I want to share it with you. He says, Slim, I'm an all-in subscriber. And an all-in subscriber is a person who gets everything from me, our charts and all the videos, and also can email me back and forth for some coaching light. So he's a subscriber that gets all of that. He says, I've been trying to follow your advice and charts. Using the charts on that Friday morning before that big melt-up back a few weeks ago, he says, I loaded up on companies with puts, which showed a potential for rolling over. Unfortunately, I didn't hear about your 50% max loss rule until too late. Now, I actually have a rule for myself, which is I try not to lose in options more than 50 or 60% of the monetary commitment I make in it, though I may lose a little bit more times if there's a fast move, or I may lose less if the analysis changes. He says, but now basically I've max loss and lost about half my available cash. What's your rule on rolling out? Boy, that is such an interesting question. First of all, I'm really sorry to hear that this has been a challenging period for you. A few things. First of all, I don't offer advice. What I do is share my knowledge and analysis on the markets and chart interpretations, how to read the charts. Everything that I've learned in this 41 years is really what I try to pour out here, just so that you can use that information for your best trading. So none of it is advice, and it's all just simply a pouring out of me really wanting to give back for all of these years I've been here. The reason I do that, of course, is so that you can make educated decisions in your trading. And what you said was, I loaded up. So that's a big red flag for me there, because besides the red flag of thinking about advice, because then you're really not making the trade your own. Also, when you start saying things like I loaded up, that would not be in alignment with anything that I ever talk to about traders as far as risk management. Basically, even if you followed a 50% loss rule, based on what you're telling me, you would still have a very significant loss in your account. So, you made a directional play in a number of companies, and they're all in the same direction, all short, and all in options buying premium. So that to me is a single play. It's like one play, right? You're short the market by being short a number of stocks by being long puts. So you're long all that premium. In a single play, in a single directional play, I never ever risk more than 5% of my account in an extreme situation, it may be as much as 10. And, with a backup of money out there, so that all of my money isn't risking, 5 or 10%. And that's what I tell traders when you're making a play, essentially. Make it so that if you're wrong, well, you still got 90% of your money, right? It's a reasonable hit because you made a big play. So you didn't do that, and it really sounds like you went way, way beyond that as far as the amount of risk. So it's trader dependent, 5% to 10% on a big play of your account, and that's not going to feel like all that much money if you want to make a lot of money, right? So that's another part of this is, how much money did you really want to make, and is it reasonable? The reason, of course, is that, being completely wrong on a trade like this, where you lose half of your money, now you're gonna shut down. You're gonna shut down emotionally. You're gonna pull back on your trading. You're not gonna be, focusing on the markets as well. Everything is gonna be way off balance. And the recovery period, take it from me because I know it. The recovery period from those kind of hits is long. And not only did you lose the money by putting excessive risk in your trades, but you lost opportunity both in learning because your focus is going to be off, and also in what you would see in the markets here for your next trades. Imagine if you only lost 10% of your account, you would be focused again and getting ready to find whatever the high quality trades are that you can be getting into right now. But you're not really going to see that because what you're concerned about is making back losses. And that's why you're asking me about rolling positions, because you want to hold on, you want to make back losses. You roll the position, you're going to be risking the other 50% of your account. So I get a sense that's where you are now, wanting to make the money back, and that's why you're asking about that. This is interesting because so many people roll trades, especially strategic option traders. They have reasons to do that. They want to extend duration. They see a benefit in the option decay, and that's why they want to do that. So they roll out, and I'm okay with that. But for me, I'm a directional trader. I'm a speculator. I only roll when I'm right. I don't roll when I'm wrong. When I'm wrong, then I'm wrong. Why do I want to roll? Why do I want to be in the position? I'm not chasing money. I mean, I've just done that too many times in my career, and it just doesn't work out. So, I don't roll. Whenever you think about rolling, and if it ever comes in your mind that you want to get back losses, you are looking backward. That's what you're doing. You're looking backward. And you're never going to be successful as a trader until you're looking forward. You can't be looking backward. There's lessons back there, and you bring them with you, and then you get better and better. But you can't be looking backward. Rolling to get back losses is a losing strategy, and it's how people just wipe out their accounts, and it really hurts them in raising their game later on in their career. I hope this is helpful to you. It's kind of lecture-like, but I've been through this in my career a lot earlier in my career, plenty of times where I've lost big money and I wanted to chase it and then lost more money, but I am well beyond that, and I hope this is a good lesson for you. So thanks for writing that to me, because I know a lot of people are going to get something valuable out of that. And one last little tidbit from an old buddy of mine, Tico, that writes to me now and then, and he says CNBC reported that between 1994 and 2011, if you own stocks only 8 days a year, you would have made 80% of the total rise for that 17-year period. Can you guess now which of those 8 days per year? Give you a second. Those are the 24 hours before every FOMC meeting. Can you imagine that? That's it. Your emails and tweets, great stuff. And we will be back very soon with my short-term view of next week. All right, the short-term view is coming up in just a couple of minutes. I want to take a little bit of your time here just to tell you about our video premium membership. That's our level 2 membership. And we have 7 different categories of videos that we rotate throughout the week. So I want to tell you just a little bit about them, and we have a great special going on right now. For the people that are interested in charting and the kind of work that we do, we have our tools for text. Just recently we did a video on the correlation between oil and oil stocks and some setups in there, and coffee and Starbucks. We also did a video just a little over a week ago that has a great chart grid that shows you setups, tools for scalpers, intraday traders, and it just does a great job of showing you how you combine momentum along with entry and exit tools. If you're a short-term trader, you don't want to miss that one. We have Trader Psychology, of which we looked at the book, The 4 Agreements, applying those lessons. We also did one recently on 16 signs of fear in your trading and how that could be really affecting you. Stock sectors, we're always looking for setups in different stock sectors. We did one recently on e-commerce stocks. We have another category called style, strategy, and plan. That's where we really look at many aspects of our trading. One we did this week was on doing a journal and then doing a trader monthly review, which I think is so important to elevate your game in trading. We do big picture analysis. The last one was on the stock market, and you don't want to miss that one because we talk about some issues for the stock market going out into next year. We do things on IRA. We call it IRA MO, where we look at strategies and allocations. And then our most popular one is Futures Speak, where we look at 6 different categories of the futures markets, 25 different futures, deep analysis applying my cycle analysis to the futures markets. These are intermediate looks in there, looking out for like a month to 3 months on the futures markets. And then we also take a little short-term look in there also. But most of our short-term stuff we do on Fridays in this Market Week show. So that's the 7 different categories of videos. It's an amazing library we're building there. And we have this special going on now where you can sign up for 3 months to start, and you'll get 1 month free. That comes out to just only 60 cents a day for all of these videos. So I encourage you to go right now and click on membership and sign up. And here comes the short-term view. All right, for the short-term view, well, this was a rougher week for us. The stock market was much stronger than we had anticipated. The midweek dip didn't get down anywhere near as far as we thought it would, and then it moved up, and up in a strong way. So even though we thought that would be the pattern, we don't get a whole lot of credit for that when it doesn't fall as deeply as we expected. We had the dollar much weaker, which helped gold also. Gold was much stronger than we expected it to be. So this, I would say, was a busy week for me because I spent a lot of the week where I was looking at these shorter term chart patterns, comparing them to the longer ones, reevaluating the scenarios, and that is actually what happens. Poorest week in a long time, and I would say that maybe in more than a year that the things were as difficult to read as I found them in last week. The best I can give myself is a 30 or 35%, and I have not done that poorly in a long time, as I say. So what do I do then? Well, I go back, I reevaluate, I revise, I pay little attention to money that was lost on some of these trades that didn't work because, well, it's gone. It's not important. What's important is that I learn, reevaluate, move forward, plant my feet firmly on the floor as I am doing right now, and look ahead. So that's what we're going to do right now, is look ahead to the next week. We're going to start out in light crude. Now, light crude was the one that I really got right, and it's been my best market in the last couple of weeks, I'd say. Really nailed the upside move that it had a couple weeks ago, and then the decline that it had this week. It almost exactly traded within the pattern that we had expected. And let's take a look here at this light crude chart. We're going to only look at daily charts here because this is the short-term view. So what we were looking for in that last week was that rally that came, and you could see it got right up into our resistance zone. You see that number 5, that's 5 days off of this low. We expected it to come down through like day 8 to 10, and there you see day 9 was the low right there. And then what's going on in here? Now, where's my analysis come from that says that we're going to get into a stair-step downward move? Well, it's the cycle patterns that we see in here. I am completing this enveloping right in here, and you could see this cycle right here from this point to this point was made up of these smaller cycles in there, and we have the same thing going on here. Now, we have this one rolling over. This came down to about the 78%. That's not a good sign, and it says that this pattern here is likely turning over already. And you could see I'm just really following the trend down as I put in this downward stair-step pattern. So for the next week, we're going to look for a brief rally up in here. We're going to look for maybe 47.90 or a little bit higher. I doubt it'll make the 48.70 number there of resistance, but it could. So I'd say a couple attempted days to the upside in here, and then beginning to roll over. The key that will tell me that I'm correct about this analysis will be if it fails, then breaks under 45.72. So that's my picture in here that I'm looking at, and I do expect that we're going to get this kind of a move right in here over this next couple of weeks. So that's the picture, and I'm going to stick with that one because that one has been working really well. Let's take a look now at the short term in gold /GC. Now, what I expected in gold was that it was going to have a down week, and it did not. And what I expected was that it was going to roll over at the 1170 number. It was kind of an extreme for me, and it did not. My pattern that I originally was looking at was this one right in here, where I thought that, and you could see the pattern still exists. It's up in there in the blue dots, but that's the revision. And I thought it would stop in here in this area and then roll over there and then come down to the support area over here or worse. So you see the pattern still exists based on the cycles, but I definitely got that one wrong, and I call that one a big miss. This is a couple of stalling dojis going on in here, and I think this again is going to be a down week because there's that declining week that we were looking for, and here's the stalling coming on here. So I think that the odds are, and now the dollar looks like it's ready to move to the upside. The euro already had some improved action the last couple days, so I'm looking for a downside move in here. If it wants to pop up a little bit first, there's big resistance on the weekly up here at about 11.99. So if it has a little bit of a pop, that's where I think it stalls, and I think that's a big number. And then I think it can come down and test support around 11.58. So that's kind of the pattern I'm looking for, a down week in gold down to 11.58. Next one we're going to look at is the euro currency /6E. I had a really nice trade in here on Thursday, as I thought that euro was going to turn to the downside. Now, again, I get no credit for this one either. The expectation was that it was going to be a down week, and it's only up by a little bit, but it's certainly not a down week, and that it would come down and test the 1260 to 1230 area. Well, it didn't do that. I mean, it only got down to 1340-ish right there, right on that 13-day moving average. Let's get a little closer look in here. And so this is the revision in here also. Now, again, the pattern is the same, and we often get a tracking between the euro and gold. So we said gold down for the week, and this looks like the euro down for the week. Of course, that's because they both trade inverse to the dollar. So we're going to look for a small down week to complete this correction in the euro. Target we're looking for is around the 1295 number. That's right in over here. And then I think that after that, we're going to get into one more up move in here, which is actually what we think is going to happen in gold also. So these guys track each other, and we're going to look for kind of a modest down week here in the euro currency. Next one we are going to look at is the bond market. Now the bond market I'm going to get half credit for here only, /ZN. We're going to look at the 30-year, and what I had expected was that it would rally and then sell off, so up early in the week and then move to the downside. My expectation was that it would stop into this sell zone right over here, and that would be the area to short. So that's what I said, that's what I did, and you see it moved up strongly on that day right there and moved through it and then turned down. So pattern I got exactly right, but it got up through my numbers there, so I only get about half credit for that one. Now, where we are right now is we're going to look for a slightly lower week in the bond market. Also, testing support in here at around 128.23. That's that 50% number where you see that line, the thicker line right there. So we're looking for a modest down week here in the 10-year right there. So something like this right here. You see this double pattern right in here. So we're in the second part of it, the nested cycle right in here. And then after that, it turns up again. So if we're looking at that for kind of a down week, we kind of think that the stock market probably inversely to that is going to hold up. So we're looking at that pattern right in there. And then a potential for another move to the upside right there. And of course, this is going to correlate with a downside that we expect to happen in the stock market. So speaking of the stock market, that was an annoying week for me in the stock market, simply because I expected the market to dip in the middle of the week. The dip wasn't strong enough for me. And then I expected another up move to be coming in the market after that, and it came early. So, just a couple days off in this timing really sometimes gets us off in our trading. And that's what happened for me as I got the timing, I would say, slightly off. And I'll show you it right in here on this daily chart. What my expectations were. So take a look here at the SPX daily. And back a couple of weeks ago, I said I thought there was going to be a dip in the market to this time period of 1013 to 1016. You can see that right there. I've had that there. I've had these two cycles that I wasn't sure about the timing giving me that zone of a correction, and you can see it just absolutely came at the right time. But then this Thursday upside move just absolutely was a surprise to me, because that came on after day 11 on the downside. Day 11 has been really, really rare. Now I'm going to hate it if it turns out that this is kind of a top day, and you can see it got right up to that resistance right there, and it moves sharply to the downside in here, because that will have me off on my counts again. Because I'm expecting the bond market to have a down week, I'm actually expecting a narrow week for the stock market in here. And of course, we got a lot of earnings reports coming out. It's hard to tell how any of that is going to affect it. But I'm going to call this narrow week with this area down over here around, let's call it 2006 on the S&P 500 on the downside, and this high area right in here where these two resistances are coming in, this 89-day moving average, and this big intermediate resistance right on the top of it. That's the area of 2030, 2033. That's really the upside that I see in here. So I'm going to call a tight week in here where they don't give up a lot of ground. But then after that, now what I left in here was my original projection so that you could see. I expected it to come down for a couple more days, then rally, and then have another big decline. Now, because it did what it did in here, I think it extends out to the same time period, you see that, and then have the big decline right over there. So it takes a different shape because it bottomed earlier. So we're going to call this a tight week here with maybe a little bit of upward chop. and then setting up for what should be a big decline, failing from this area in here. We have the intraday patterns in here that are showing us still the short terms have not turned bullish yet, and the longer term patterns in here are still negative in the S&P 500. So there's nothing in here that says to me that we're going to get a big breakout on the upside, just maybe some more chop in here and then turning to the downside. I want to put up the VIX, and that's not the VIX, that's the VIS. So here is the VIX, VIX, and this is the daily chart. So this was nailed by us, actually, and we had expected, you see those little blue lines in there, that little blue line, up or a little bit and then down. We put those in last week, saying that, well, we expected the VIX to follow that pattern, and that was perfect. It was a day off as far as I'm concerned, as far as the stock market goes. But here's what this looks like. This looks like maybe 3-4 days or so of still pressure on the VIX. Then it turns up again, and that coincides with what we're looking for, kind of choppy upward action in the stock market, and then turning down again. Now, I don't usually show the weekly patterns in here, but I want to show this to you now because of how important this is. We are just now finishing a downward cycle, these two nested cycles in here on the weekly chart. That calls for, somewhere out here in the next few weeks, a big upturn in implied volatility. So that is in alignment with what we believe is going to be a failure at these resistance zones. So wanted to pop in that look at the weekly. I've had some people tell me that I give too much away here on this free show, but sometimes I just want to share some of this analysis that looks so good to me. And that is what it looks like for the stock market, where it looks like could hold up for a few more days in here, narrow range, but then the risk is going to pick up again to move to the downside. So that is it. That is our short-term view for the week. Let's hope that next week the analysis comes out better than it did this week. Don't forget to go to the membership site. You want to get these charts. You can get them on your TOS platform. We send out a new link every single week. So lots of people loving what we put out there. Lots of annotations, all the cycle analysis. You want to have it on your platform, you can do that. That's it for the Market Week show. I hope you found it valuable. I'm going to see you next week, and I'm always asking you to have great trading.
Well, I'm going to sit